Towards a New Socialism. Section. Alternatives to Foreign Exchange. The Soviet socialist pattern was to maintain an inconvertible currency which did not circulate abroad, and to pay for imports in dollars or marks. We are proposing an eternal economic system in which money as a means of payment is phased out in favor of non-circulating labor credits. These labor credits are not money in the normal sense, in that they can only be used by citizens to pay for publicly produced goods and services. They cannot circulate or be used as capital. When this approach is applied to the problem of overseas trade, it implies a system in some ways diametrically opposed to foreign exchange policy on the Soviet model. These countries paid for their foreign trade in hard currency, and often restricted the export of their own currency by means of exchange controls. From the 1940s to the 60s, the British government followed a similar policy. In outline, what we propose is the reverse of this. Imports from the capitalist world are paid for in labor credits. Labor credits may be exported and can circulate abroad, but not at home. And the import of foreign currency is outlawed. We wish to prevent the formation of money capital as a social relation within the domestic economy, which is why labor credits are not allowed to circulate domestically. In the capitalist world, money capital already exists, so there is no objection to labor credits of the socialist commonwealth circulating between foreign capitalists. Footnote. The word commonwealth has taken on new overtones since the counter-revolution in the former USSR. Originating as an English translation of the Latin res publica, or republic. It was the tag attached to the revolutionary dictatorship established after the overthrow of the Scottish and English monarchies of the 17th century. It continued to have revolutionary associations well into this century, with the term Commonwealth being used by English socialists as a synonym for a socialist republic. It has the great virtue of directly expressing the idea of common ownership in its title. To give the 20th century monarchy some populist legitimacy in former colonies, this revolutionary title was incongruously adopted by the British state. It is in this conservative guise that it apparently appealed to Yeltsin. End of footnote. A capitalist firm that supplies the Commonwealth with imports will be given an account with the Ministry of Foreign Trade and credited with a certain number of hours of labor. The firm may then obtain a transferable certificate of credit from the Trade Ministry. These certificates of labor credit would then serve as non-interest-bearing negotiable instruments, which the holders could sell on the financial markets for whatever currency they wished. The demand for such instruments would come from companies who want to buy Commonwealth exports. It is unnecessary for the Commonwealth Trade Ministry to establish an exchange rate. That is a private matter for the capitalist financial markets. Since both exports and imports are evaluated and international transactions settled in labor vouchers, the dollar or yen price of these on the world market can be ignored when deciding what to export or import. All that matters to the socialist economy is the product of the foreign currency price of goods and the exchange rate. Viewed in this way, foreign trade is just a specialized branch of production that produces imported goods and consumes exported goods. It is then possible to integrate it into a general planning model. It follows that decisions as to which goods are to be imported and which exported should be the responsibility of the planning authorities, since they have databases on the relative labor costs of different production techniques. Given a target level of production of some commodity, they can determine whether it is optimal to import it or produce it domestically. Goods are only offered for export if the labor voucher price yielded is above the labor input required to produce them. Imports are only purchased if the labor value price at which they are being sold is lower than the amount of labor value that would be needed to produce them domestically. If these conditions are satisfied, it is self-evident from the labor theory of value that foreign trade will yield an overall saving in effort to the country. Table 10.1. Labor time balance of payments. Columns are good, domestic cost, price offered, and decision. So the good is oil, the domestic cost is 1 million hours, the price is offered is 1.5 million hours, then the decision is to export it. Cars, the domestic cost is 2 million hours, and if the price offered is 1.5 million, then the decision is to import it. So the value of exports is 1 million hours in domestic units. The value of imports is 2 million hours in domestic units. And the labor time deficit is 1 million hours in domestic units. An interesting consequence of this is that the Commonwealth will always run a trade deficit when measured in domestic labor units. For example, consider a Norwegian Commonwealth that exports oil and imports cars, as was described in Table 10.1. The Norwegians export oil that took 1 million hours to produce, and get back cars which would have taken 2 million hours had they been made in Norway. Hence, in domestic terms, they import twice as much as they export. Although in terms of prices actually paid, trade is balanced. When things are computed in terms of labor costs, it is clear that a country makes no net gain unless it runs a trade deficit. This is an expression under socialist property relations of the mercantile profit predicted by Ricardian theory. The foreign trade sector of production differs from domestic branches in that its input-output coefficients are highly volatile. It may well be that the frequency of oscillation of international prices will be too high for the domestic economy to track effectively. Indeed, this is almost inevitable since commodity price fluctuations are an expression of the differential time constants of supply and demand. For example, computer memory chip prices on the world market fluctuate in a 2 or 3 year cycle. At the peak of the price cycle, the Commonwealth might be faced with a price in terms of labor that was greater than that which would be incurred if a new factory were set up to produce memory chips at home. But to set up and commission that production line would take a year or two, by which point the world market will have fallen to a trough level that would make imports cheaper than the domestic product. These world price fluctuations depend on 2 time constants: the time it takes to commission new production facilities, and the time taken for new uses for computers to be found when chip prices are low. It is because both constants are of the same time order that fluctuations occur. If semiconductor wafers could be manufactured as easily as hamburgers, then the production time constant would be a matter of weeks. And in that case, prices would not fluctuate, They would just move steadily up with inflation or down with improvements in production technology. To deal with such fluctuations, the planning agency would have to apply weightings to prices that would dampen out short-term variations. Decisions to import or export would then be based upon long-run price trends rather than instantaneous prices. End of section.